Oh, it's a pleasure to be here. Thanks very much for the invitation.
Yeah, it's gotten a little bit warmer here in Chicago, and the ice is melting, and I think a lot of people are excited to hear about stock screens tonight.
Let's hope so. Let's hope they'll find some interesting candidates when they complete the process.
Yeah, so I'll be watching the questions panel. So if you have questions, again, I want to remind folks, please submit them at any time. We'll be in there, and we'll let John get started, and then I'll chime in when we have an appropriate question.
Thank you so much.
Thank you.
So, welcome. And I was taking a look a little bit past as far as how we've been doing stock screens over the years, and I've been with the association for many many years. And in fact, back in the 1990s, I started writing articles about stock screens. And really, the whole purpose of a screen or a filter is to help provide some sort of basic format that you could make decisions in a systematic, organized way. And tonight's discussion, I'm going to try to cover a little bit about some of the benefits and limitations of stock screens, how really you should go about to perhaps pick a stock screen that fits with your approach. And I'll spend most of the time tonight talking about the resources that you have as an association member on our website. So, what is screening? In a very, very specific way, we're talking about creating some sort of specific quantitative elements, some criteria that you could take a large universe of stocks. There's over 6,000 publicly traded stocks in the U.S. now, and you're trying to take that large universe of stocks and narrow it down to a handful that warrant further analysis, or that by themselves might be a large enough portfolio that you could use as an investable portfolio. So really, the goal is to be systematic in the approach. I mean, too often you turn on the TV and you're getting tips and ideas as far as this stock is good or that stock is bad. And what I struggle with is, okay, that sounds like a good idea, but how does one go about and actually determine whether or not that stock makes sense for me, and how do I determine when it's time to sell it as well? And screening is sort of the process of taking a set of filters and applying them to a set of a large universe of stocks, or it could be funds if it's a fund screen, and get it down to a small subset of investable ideas. And then the second step to that, we're not going to get into this involved really tonight, is the valuation, where you could then get an in-depth look at that stock and see if it really makes sense to buy at this point in time. So, why screen? Why do you care about screening? And first of all, too often, do you want to be dependent upon ideas that come across your email inbox, or come across various TV shows you might be watching? So really, with screening, you're going to find an approach that matches your investment style, and you're going to come across stock ideas you might not have come across otherwise. And you're going to avoid wasting your time on companies that don't meet your basic criteria. So if I'm a value investor, if I like to buy stocks, a dollar's worth of stock at 50 cents, I can set up parameters that help identify those particular companies. If I, on the other hand, am more of a growth investor, momentum investor, looking at price momentum, I can go ahead and set up filters that only those companies that match that particular parameter are interesting to me. So it really adds an element of discipline. It forces you to first think in advance, why am I buying this stock? Why am I buying this company? Also, it helps you understand why you might want to go ahead and sell it as well. So it helps really focus on why it is you're investing, what it is you're investing in, and makes you think in advance about your investing style. So you're not just simply, kind of blowing in the wind and just picking stocks somewhat willy-nilly. Now, again, there are potential pitfalls as well. You're always dependent upon how good the data is underneath the screen. Is the data itself of quality? Is it helpful or not? And you're limited to primarily quantitative factors. So, brand strength, competitive position, is the management good? Those are things that really kind of have to be evaluated separately, if at all. So you're only going to look at really quantitative things that could be found on the balance sheet, income statement, ratios, price information. So that's one thing to consider. It's going to be strictly quantitative in its nature. And many screens are very absolute in how they come across with their passing companies. if you have a screen that's looking at price to book less than 1.0, a company can be interesting with a price to book of 1.01, and it's not going to pass your filter. So you might miss some companies on the margin that meet most but not all the criteria. And the other thing is always, too often we tend to fall into the trap of simply looking at companies that we're familiar with, industries we're familiar with. And when it comes to stock screening, what you may find, even if you're following one approach over time, different kinds of industries may come into favor, may be exposed to stocks you've never heard of. And it takes a little bit of trust to develop in that screen as to, yes, I understand why this company is passing now, or why this industry is passing now, and I'm willing to take the time and effort to invest in that company because the screen is looking for potentially, let's say, value stocks or growth stocks, and it's passing those kind of companies right now. So it's going to push your comfort level at times as far as the types of companies that pass. So really, the whole process here, and it's too often to want to chase performance. Just, people come to me and ask, well, what screen should I use, and what's the best screen to go ahead and pick? And they too often they look at this the performance numbers. But really, it starts with understanding your own personal philosophy to investing, because you want to be able to trust in the system in really good times and bads. Because really, what we found is that there are times where a particular screening approach will be in favor and out of favor. It'll work long term, but you may be tested in your resolve at time. And also, how much time are you willing to take? Do you really have the time? If you're going to be looking at a momentum strategy that has a lot of turnover, do you have the personal time to actually go ahead and analyze that? And do you have the commitment to do that? The risk tolerance. Maybe you're better not suited towards doing a momentum approach if you can't be following the stocks and the approach on a daily basis. Perhaps you're better suited for more of a value approach. You kind of sit back, buy your bargains, and then wait for the market to go ahead and find your value. So really, it's important to first come up with a philosophy and let your philosophy sort of drive the screens. Now, if you're going and building your own screens, and we've built these for you, and our focus tonight will be on the predefined screens that exist within AI.com. But what you're going to find, and what we've found, is that good quality screens have both primary criteria and secondary criteria. So the primary criteria help you find the kind of companies that match up with what you're looking for. If you're a bargain hunter, your primary criteria might be, give me all stocks with a PE below the industry norm. And that's going to give you your cheap stocks. You're going to want some secondary criteria or conditioning criteria that say, yeah, this stock is cheap, but it's not cheap because it's a bad stock. It's cheap perhaps because it's neglected. So you're going to have potentially looking at some minimum level of growth, or having some ability to some profitability or some strength, financial strength. So most good quality screens, and we've worked very hard in terms of developing the screens we're going to present tonight on our website to have both primary criteria that help find the type of screen that you're looking for, and secondly, additional conditioning screens that help to make sure, even though the company is cheap, it doesn't deserve to be, it's not a value trap. It's there and it has the potential to get better. So really, good screens have both primary and secondary criteria. And other thing to keep in mind, the smaller the size of your portfolio in terms of number of companies, the more important it is to do detailed analysis. If you're only holding a few companies, you better really know those companies very well. Once you start holding more companies past 15, 20, you could start to do a little bit less analysis, perhaps rely more on the screen to come up with your candidates. But the best screen is a starting point for further analysis. You want to make sure the data is good, it's timely, and it's going to make sense going forward. So at the association, and I was looking back at what we've done, going back, to the 90s, we started looking at the approaches of famous investors. People like Peter Lynch was one of the first articles that we did as far as looking at his approach. These are gurus. We've also looked at academic studies. So we've taken into account factors that look at things like price to book or size, as well as just popular investment techniques, the PEG ratio, earnings estimates, earnings revisions. So we've taken and examined the characteristics of these various gurus and popular approaches, and we've built a wide array of screening strategies that are available on our website. And it kind of started off kind of as a not so much to find the best approach, but we started tracking monthly performance of these approaches, and it was more curiosity as to And how will these approaches work in different market environments? How many companies will typically pass? Is there some value to them? How volatile are they? So, and we have FAQs on our website, and I'll point them out to you later on, that really talk about how we do this. We create hypothetical portfolios. So when we have a screening approach, and let's say 30 companies pass at the end of January, we'll run that same screen at the end of February, and in effect, we'll sell all the stocks that no longer pass the screen and invest equally in those new set of companies that pass. So we have, it's really hypothetical. It's a best case scenario. There's no time slippage. There are no commissions, no taxes. We also don't take into account any kind of income that these stocks may generate. So our goal is just to kind of get a simple understanding of how these approaches work in different environments. So we track the performance and the volatility of these approaches on our website, and I'll point those resources out to you later. And again, when it comes to what people get, and a common question we have from members, and we've been doing this, really from the beginning. So AAII members, your membership gives you access to look at the analysis of all these approaches online, and you could also see month-end passing company lists. So you can always get, with your membership, you can get the full detail on how these approaches are developed, how they performed over time, and which companies have passed at the end of last month. We have some additional levels. The A+ Investor, Platinum, Stock Investor Pro subscribers, they have the ability to also look at the passing company results every day. They have a little bit extra ability as far as more frequent information. Whether or not once a month is good enough for you, if you're a value investor and you're looking at your portfolio quarterly, that could be all you need. If you want to take a look at a more active approach to your investing, perhaps you want the daily screens. So it's up to you as far as whether or not you find value in having the daily screens versus the month-end screens. So let's talk a little bit about our website. And the screening tools we'll be discussing tonight all fall within the screening section of our site. And this is referenced by clicking on the screening tab here. You want to be logged in as a member. And the most common tools are displayed at the top of this website. So the stock-related screens are located in this section, and we have some ETF tools as well as fund screening tools. And let's talk a little bit about what some of these resources are. You can also, if you happen to hover over the screening bar on our website, you'll get a drop-down that in effect duplicates many of those same links. It gives you a few additional links such as FAQs and a guide to stock screening, but we try to in effect replicate the tools that you can get on that homepage as well. So if you want to hover over it and get to some of these tools, you can do so. So I'm going to spend a little bit of time first talking about factor screens and what you as a member have access to, and what are factor screens. So factor screens are based or developed using common techniques that have shown either by academic studies or common sense as far as old investment techniques to have some predictive value to future relationship. And so we take our screens and we break them down between factor screens that are based more on just known quantitative factors, versus guru screens that were developed using the teachings and works of famous investors. So factor screens are those based upon common approaches. So fundamental rule of thumb was a common approach that combines things like price to book and elements like that. Dogs of the Dow, taking a look at the stocks of the Dow that are most highest yielding in there. Earnings estimate revisions are other ones here. So when you click on this, again, the focus here often is on these annual return, but let's look past that a little bit for now. So any screen, whether it's a factor screen or a guru screen, we've taken the effort to try to categorize what are the factors, what are the elements that help determine what passes in those screens. So in the case of the ADR screen, it has some element of value as well as some element of momentum being price momentum. And so these are the factors that we use or categorize everything that whether it's based upon a guru or whether it's based upon factors. We try to capture whether or not something has some element of value, growth, momentum, size, earnings estimates, has some dividend yield factor, has some level of quality requirement, whether it's perhaps segmented to a specific industry or sector, or we also have kind of a broad category called other. I think insiders perhaps falls into that category, insider trade. So again, if you click on this little question mark next to factors, you'll then get a deeper explanation as to what we mean by value or growth or momentum. And again, momentum is price momentum. Size is the screens that are smaller in nature. Earnings estimates, screens that require some sort of earnings estimate revision, earnings surprise. Yield, there's some requirement for income in there. So when you start to look for a screening approach that makes sense for you, you're going to focus in a little bit on, what kind of qualities drive these particular screens. And the other tab that's really going to help you even more, I think, initially than the performance tab is the characteristics tab. So what we do is we take some common measures of companies, PE for valuation, PE to earnings estimated growth, price to book ratio, price to sales ratio, dividend yield, the historical EPS growth, the expected earnings per share growth, market cap, how large or small the company is, what is its 52-week relative strength. In this case, it looks to be a index, not a rank. So in this case, the ADR screen, as an example, has the companies that are in the ADR screen have an average PE ratio of 11. The PEG ratio, the PE to earnings estimated growth, is 1.3, a little bit on the more affordable side relative to, say, the dividend yield one, which is 3.3. The price to book ratio is 2.2. The price to sales ratio is 1.0. The stocks in the ADR screen don't typically pay a dividend, so if income is important to you, you might go towards more the dividend yield screen or the dogs of the Dow screen. They have a pretty strong historical growth, and their future growth is expected to be pretty high. And they have an average market cap or median market cap of about 2.5 billion. On average, they've underperformed the S&P by about 5% over the last 52 weeks. And again, this is another important column, very, very important column to look at. And these are the monthly holdings. So what you'll find, some screens may look to have very good performance, but only a small number of stocks pass them. And that makes it difficult to invest in that strategy. So I always take a look at the average number of companies that have passed a given approach over time. Now, most of the factor screens, they may always look for 30 stocks. You'll see on average 30. And the stocks of the Dow, same thing. It's the lowest priced 5 of the high 10 yielding stocks in the Dow. So that tells us on average how many companies pass. So that's, if there's 30 stocks that pass every month, likelihood you'll find a stock that's interesting or two in that group. If it's only 1 or 2, you may not be able to invest in it when you want to. And this is the monthly turnover. So how many when we run the screen from month to month, on average, how many stocks leave the portfolio every month? The higher the turnover, the more frequent you're going to have to turn over your portfolio if you want to keep up with it and have a sense for how often the stocks move from it. Low turnover stocks, like a 7.4, that means this is going to be a stable approach. If you have a longer term perspective, might be more suited towards you. The other column or tab you'll find even when looking within the Guru thing is the grades. And our focus tonight so much is not on the grades. It's more of an element of valuation. But we've developed some grading systems and some scoring systems at the association over the last year. And in it, we look at things like value, growth, momentum, EPS, revisions, and quality. And we in effect rank all the companies based upon those factors. And when you click on the grades tab within the factors screen, you'll have a sense for how typically the dogs of the Dow screen about average in valuation, average in growth, a little bit below average on momentum, a little bit above average with a B grade in estimate revisions, and very high quality. So it gives you a little bit of a sense of the kind of companies that typically make up a screen. Are they value approach? Are the earnings estimate revisions down? Not surprising, have poor earnings revisions, less so on poor growth, about C average growth, not much value there, and momentum is about average. So again, it gives you a sense for the kinds of companies. Not surprising, value on the move, has a little bit higher momentum, a little higher revisions in there as well. It gives you a further confirmation of the kind of companies that typically will be passing and making up these different parameters of the screens that are in here. So, and again, the A+ investors and platinum investors, you have access to the individual grades. Our focus tonight is more on the screening side, not the evaluation side, but those are tools you could use to evaluate companies that then further pass any approach. Now, the guru strategies, and we've got over 42 different guru strategies. Some of them are multiple ones for a given guru. So again, our goal, these are not stocks or approaches that they themselves may not pick, but these are people that have given either through books, presentations, articles, interviews, a good understanding of how they go ahead and make their stock decisions and why. And we've taken the time and effort to interpret their approaches and try to quantify them in a screen. And when you click on the Guru's screen section of our presentation and of our website, you'll get a listing of all the different Guru screens, and you can go ahead and look at the factors. So you get a better sense now, like the Bajkowski F-score has a pretty good long-term track record, 16.2% annually, pretty high volatile. A risk index of 1 would be equal to the market. So this is more than 2 times riskier than the market. Its focus is on value and quality are the 2 factors that drive that particular screen. And when we look on the characteristics, sorry about that, it'll show you how many companies pass on average. So it'll be helpful in that regard to get a sense as far as that information is concerned. Now, if you have questions as far as how we go ahead and track the performance, if you click on the FAQs section under screening, you'll come up with an FAQ, and in here they'll have further information on how we create these portfolios, how often they're rebalanced, how these performance results are created. So it gives you a little bit of background information in case you want to research that on your own.
John, I wanted to stop you for a second because
sure.
a question came up that I thought was relevant for now. On the grades tab, which I'm sure you're going to go over, the question came up: what period of time does the grade cover on the screen?
Well, the grades are meant to be contemporary grades. So right now, they would point to, in the case of Logitech here, it has a value grade of D, which is the grade as of today that the particular company had. So based upon its relatively high price to sales, price earnings ratio relative to all companies is relatively expensive. It has a lot of growth to it, and that's based upon a range of historical and expected growth. Its price momentum is a weighted 4-quarter weighted price momentum element. Earnings estimate revisions take into account both surprise and changes to revisions, and quality is for its most recently reported financials. So it's data as of today. Some of these factors, like value, consider the current price relative to things such as earnings or book value. Growth looks at historical growth in terms of earnings and sales and things like that. Price momentum, last year of price comparative performance to the marketplace, and estimate revisions are looking at how it's done recently as far as revisions. So the grades are contemporary, but some factors are backward looking and some factors are forward looking.
And just one additional question, and I'll let you continue. So the screening tab has a performance tab, and when AAII calculates the performance of each screen, what pricing is being assumed here? For example, are you assuming the stocks in the screen are bought at the open on the day after the data is released? Or if you could get a little bit of clarification on that.
Sure. Yeah, and if you go to the FAQs section of our website, I think perhaps I was right here. It goes into it in greater detail than we perhaps want to hear, but we basically are very simple in our approach. We take a look at the stocks that pass, and we simply use the closing price of 1 month versus the closing price of the prior month. So we don't look at opens or bid-ask spreads. There's no time slippage. It's a very best case scenario, and our goal is not to suggest these are investable portfolios at this price point, but more of typically how does this screen do over time.
Gotcha. Thank you.
Certainly. So looking at the guru screening characteristics, and this is why it's important then to take a look at beyond just the performance is, if you're going to be following an approach, and look at the Peter Lynch approach, for example. It has price earnings in it as a component, has looks at stocks that are in the portfolio that are relatively low priced, attractive on a PEG ratio, price to book ratio, price to sales ratio. Actually, there's a dividend component. A lot of the stocks that are paying a dividend, it tends to be in the mid cap size. Some of these screens are going to be smaller. The Driehaus Revised has really a small market cap. So if you're focusing on small companies, they might be in there. Peter Lynch, the approach looks to be a little bit stocks that have fallen out of favor perhaps over the last year. But on average, you're going to find 19 stocks that pass. Other approaches, look at this one. This one only has 2. So on average, only 2 stocks pass this approach. It's going to be very difficult to invest in that approach. Some of these companies currently have no stocks that pass. So if you were following these approaches, you would have no ability to find any current stock candidates. So I always take a look at the average number of holdings and the turnover to get a sense for how investable a particular approach is. And this information, these characteristics are updated every day, and they give you the consensus information for the different approaches that we have. And one of the things you could do then is if you find an approach, and this is a feature that we're just opening up to members now, in that, and it may take a while for all of these elements to kind of filter through the different parts of our stock screening website. But if there's an approach that you really kind of want to follow over time, let's say you like the Lakonishek approach, and you can go ahead and favorite it, and it'll be added to the My Screens section, and we'll cover that in greater detail later. But it's the ability for you to then track that stock's passing that approach over time and do some additional analytics. So again, members can track the screens. Data will be updated once a month as far as passing companies, but you can at least track those companies and track that screen over time. If you click on the down arrow next to one of these strategies, it'll present the list of companies that are in there. You can then go ahead and look at those companies, click on the link, and do some additional research. If you click on the company's screen name itself, it then gets you into some information that is presented for each of these approaches. So every screen that we have programmed on our website, we give you some basic performance information, but more importantly, we provide information as to how this approach was developed. In the case of why Lakonishek chose the techniques that he did, how we went ahead and interpreted and made them quantitative. And so it gives you an understanding, and you start to then get a better sense of, yes, this is an approach that I want to follow, and I understand why it's being done. And it gives you some confidence as to the educational part of it. And it also gives you all the criteria at the end. So beyond telling you how we develop the criteria, what are the criteria? So in this case, the Lakonishek approach, you're going to look for companies that are at least 50 million in market cap size. We're going to avoid OTC stocks. We're going to avoid foreign stocks traded in the US as ADRs. We're also going to ignore, looks like real estate companies and certain banks. And we're going to look, our primary filter here, we talked about a primary approach for picking stocks. So in the case of Lakonishek, we're looking for either any of these: price to price earnings, price to book, price to cash flow, or price to sales. We're looking for those values to be lower than the median within the company's industry. And that makes it part of the value. That's the value element. Then it has some price momentum, so looking for some positive price momentum for both 26 weeks and 13 weeks. Looking for companies that have had positive revisions, or at least no downward revisions, at least one upward revision for the current year, and no analysts downgrading the company. So what's driving this particular screen is avoiding microcap stocks. It's avoiding foreign stocks listed in the US. It's looking for stocks that are cheaper than average, not the cheapest stocks, but then we want stocks that have shown some price momentum and have had some upward revisions to earnings. These are the factors that drive this particular screen. And then as an investor, you can then go ahead and look at the companies that pass. And again, as a member, you get access to the monthly ones. And then if you're an A+ investor subscriber, you get access to companies that are passing every day. And if you click on the little yellow plus sign next to a company, catches your interest, you go ahead and click on that. It'll then be added to your portfolio, and a prompt will come up asking you to either add it to an existing portfolio, or you can go ahead and build a new portfolio. So it's a chance to take the companies that pass a particular screen and start tracking it in the portfolio tracker that we have on AAII.com. So that's sort of the overview of the kind of information we have available within each screen. And then what happens now, I guess, is people start to think, well, okay, so I understand how to do some in-depth research on the individual screening strategies. How do I go ahead and pick some of these strategies based upon information that's there? And any questions before I continue, Ryan?
Yes, actually, we have a lot of questions. I'll go ahead and this person appears to be an A+ investor subscriber, and perhaps your presentation will get into this. But it says, is there a way using A+ investor to omit companies from a screen with a market capitalization of less than a given amount? Say, in this example, $225 million.
Yeah, at the moment, no. We are actually working on developing a custom screening tool, and we hope to have a internal alpha version of that by the quarter's end, and be rolling it out to A+ investor subscribers by summer. So at the moment, no, but it is something we're working on as far as creating a custom screening tool.
Mark asks, for the characteristics of the screens, is there a table or some list that shows which characteristics are good or bad, too high or too low, for example? Is there something out there for folks to kind of reference?
Yeah, there is no specific, I guess, table of that nature. It probably depends a little bit more on the style, and so it would kind of coincide with what your beliefs are. If you're a value investor, you probably are going to focus in on numbers that are lower. If you're more of a growth investor, you might ignore that. So what you'll probably look at, it'll probably getting an understanding of what you think is reasonable for the approach you're taking, and then doing some reading as to how we constructed the different approaches, and determining why they happen to pick a low PE, or why they pick price to book.
And then I'll ask this last question before we continue on with the presentation. Scott asks, is there a time of the month that the screens generally do better or worse, or a date that these all get updated and get analyzed all at the same time?
I mean, unfortunately, the market tends to be somewhat random. I mean, if you look back even in January, I believe the last week of January was pretty negative, and then the markets came roaring back in the beginning of February. So it's very difficult to tell day to day how the market will be doing in advance. We tend to update this information fairly quickly, 1 or 2 days into the new trading month, information is available. So if you're a member, click, come back, and normally I think within a day or two after the business days within the new month, you'll see information available for you.
Gotcha. Okay, thank you.
You're welcome. So some of the tools I'm going to focus on now help you rate and rank the different screens based upon different elements of approaching. So power rankings is really just a sorting tool. So if you go to the screening page and click on power rankings, you're going to get a power ranking tool, and you can go ahead and determine how it is you wish to sort your screeners. You can do against all the different strategies. You can focus in on just the guru strategies or just the factor strategies. In this case, this is a power ranking looking at all screens at performance since inception, and the number one performing screen in that context, performance only, is the O'Shaughnessy Tiny Titan screen. And if you wanted then to look at the current companies that pass, you can click on this to see all 25. Here are the five of the companies that pass currently, and then our formula takes you to the detailed information that we looked at as far as how this particular strategy is built. And if you have something that's yellow in here, that means you favorited that particular screen and made it part of the My Screen thing. So I tend to look at longer term approaches whether it's 20 years inception or risk adjusted, and even risk index, get a sense for how volatile it is, which screens are more volatile, or how has it performed in the most recent bull or bear market. You could also go ahead, and one of the tables I typically look at, and a lot of our members do as well, if you hover over the screening things, you get the Explore All Screens link. It points you here to a list of all the screens, but also what it does provide for people. Some of our members like to download spreadsheets. This gives you a link of monthly performance of all these different approaches going back, 20 plus years. So if you really get into the data and analysis of that information, this is a spreadsheet a lot of our members take a look at. And when you're in this particular approach, then you can click on any of these tabs, these columns here, and it'll all of a sudden sort them based upon the risk index or return from inception, 10-year return or whatnot. The performance history, which is also accessible from that drop-down tab, gives you a year-by-year accounting of these different approaches for the last 15 years or so. It also gives you what factors we're using for them and an annualized total. And again, the goal here is if you click on these, you can get a sense for how they rank. And what I like to look at is some level of consistency and some understanding of how the market's done. So if I'm, Neo Can Slim is very much a momentum, growth and momentum approach. How is it done? Wow, it was up 25% in January. Very strong last year. It has a very consistent record over time. That's something you look for in a good quality screen. And towards the bottom of this table, we also have benchmarks for the different market indices. So you get a sense for how the strategy is done relative to the market as a whole. So again, has a good, strong track record historically, and it's fairly consistent over time, which is our good things to look for as far as an approach. And you can't really ignore risk. And risk you're really talking about is volatility. And these approaches, in many cases, on a short-term basis, can be very volatile. The risk index compares how the performance is against the market as a whole. In this case, you see a risk index of 2.0. It's twice as volatile as the overall marketplace. And then we have a risk-adjusted return. Anytime you have a question on a number or what it means, you click on that little question mark, that it'll bring up a web page to help explain it. You can look at annual performance, how it's done in the bull and bear market, the best month, the worst month in a given year, in a given strategy. So some of these strategies have lost as much as 36% in 1 month. And they've also gained that much. In this case, we have the O'Neill canceling approach. It's had as much as a 70% gain in 1 month and a 23% loss in another month. So a little bit of a sense for how volatile these approaches can be over time. And then touching on the My Screens part of it. So to the extent that you found an approach or 2 or 3 or 4 that makes sense to you, if you click on the My Screens, it'll help you save that approach. And again, if you click on the My Screens part, these are all the screens that have been saved under my account. And it then tells you the current characteristics of those stocks of that particular approach. You can click on the down arrow and see which companies are currently passing on them if you want to start tracking them. Kind of interesting right now, the Berkshire Hathaway happens to pass the Lynch screen. And then you can look at the characteristics of the strategy as a whole, as well as the stocks that make up the strategy. Another interesting tab on the My Screens approach are the My Stocks passing any screen. What My Stocks here represent are stocks that have been saved to your portfolio or portfolios. So if you've saved a bunch of stocks, which of them currently are passing any screen? And in this case, I must have Adobe, one of my portfolios. Adobe is passing 3 screens. It's passing the investor equality growth, the PE relative screen, and the return on equity screen. And it's held in one portfolio. It happens to be held in the mixed asset portfolio. These are all links then too. These underlying lines are links. You can go ahead and take a look at what screen that is and why, what drives it, or you could go ahead and take a look at that portfolio. And under My Screens, the other one that's kind of interesting approach is the ability to see how many stocks pass more than one approach, more than one screen. So in this case, we have D.R. Horton's which actually passes 7 different screens right now. And these are the 7 that it passes. The Buffettology, EPS, Dreamin' with estimate revisions, estimate up 5%, investor equality screen, the NEF screen, the PE relative, and the Templeton screen. And I don't have any portfolios currently. If I did, it would show up in this particular column here. And anything that has a gold star next to it, those are screens that I favorited and as made part of my screens, part of the tracking system. So this is an interesting way to get a sense for if you think there's some merit to finding stocks that are passing multiple screens. It might be, sometimes a lot of our members find this to be a very interesting approach for finding some stock candidates to consider. And if you find something like this, you can go ahead and click the plus sign next to the company name, and then you can go ahead and add it to a portfolio. And the screens and the approaches we've talked about up till now are available to all members. There are some tools, and the A+ grade screener tool is one of them, that is only available if you are a subscriber to A+ Investor or Platinum. And if you click on the A+ grader screen, it's an interesting, very interesting tool, and it focuses on the grades we talked about before: the growth, value, momentum, estimate revisions, and quality. And you could use these sliders here to specify how many, what's the minimum and maximum grade you want under those 5 elements. So if you go ahead, in this case, start off with all 6,155 companies, you can then go ahead, and in this case, I required that only companies that have a value grade of A or B, a growth grade of A or B, momentum grade of A or B, revisions of A or B, and also quality of A or B or better pass. So I was left with 34 companies that have A or B grades across all 5. And I can go ahead and look down here and I can sort them. I could then see, I could do some further analysis and see if any of these stocks are interesting to me to look at for either building into a portfolio or doing an in-depth comparison. And other things that the A+ stock rater can do is also start to get involved in comparing the grades against portfolios, screens, sectors, or industries. So in this particular case, I went ahead and I loaded in the estimate revision top 30 screen. So, one of the things we found is that, the companies that have had either positive revisions or positive surprises, even after that initial big pop they often get on that surprise or revision, they tend to go on and have outperform the market for some period afterwards. By the same token, companies that have had negative surprises typically underperform the market for some period of time as well. So as an investor, and it's more pronounced for growth companies, it's a bigger impact for in terms of a positive surprise is more important for a value company. A negative surprise is more important for a growth company because they both cause you to reevaluate the firm. So if a value stock has a positive surprise, makes people think they need to reevaluate the quality of the company, they typically boost up its stock price. A growth company has a negative surprise, people all of a sudden become skittish about that company, and often they'll start to underperform for some period afterwards. So if you have a company that's had a negative surprise, don't hold on to it fearing that you want to wait to get out for it to come back up before you get out. If you're going to be a disciplined investor, you're better off looking for companies that have positive earnings surprises. So in this case, I went ahead and I selected the estimate revision top 30 screen. So these are top 30 companies as far as revisions recently. And I went ahead and I required that the value be A or B or better, the growth be at least a C, and I require that the quality be at least a D. Left me with 11 companies, and that then gives me the ability to take some screens and do some additional filtering on them. So I think it's a very powerful tool. You could also go ahead and load your portfolios and do a similar analysis, or if you want to look at a sector and see which stocks within a sector are doing well. That's a very, I think, interesting approach to that place. The other tool I want to touch upon briefly, and it's not so much a tool as much as it is commentary. So at the association, one of the things we want to always do is help provide some education. And once a week, we put out an email, and it either gives you some stock ideas as far as how to analyze a stock, or it goes through a screen and talks about the approach of the screen. So it's the commentary section right here on the screening page. But it's a e-newsletter you can subscribe to. If you go to your account and click on email preferences, if you want to go ahead and get this weekly email, you go ahead and make sure that the AAII stock ideas update is selected. You'll be signed in to get it. In fact, this week's email went out, and it talks about stocks with rising dividends. And then it goes ahead and is written by Derek typically, and he provides some information on the stocks that pass this particular filter. So I always find it interesting reading. And one article that if you want to know more about how to construct winning stock screens and the factors that have been shown to work over time, this is an article. It's kind of an evergreen article, we call it. It's always available. But this is often, if you want to get a understanding of how to construct a screen or how we've constructed them and the type of factors that have been shown to work, this is, I think, a good idea for some feedback as far as that is concerned. So kind of summarizing, as a member, you have access to the Guru and Factor screens with monthly passing company lists. You have access to all the historical performance and risk analysis that we presented here. You have the ability to save and favorite screens and access the My Screens thing. That's something we're just rolling out right now. The ability to do some basic power rankings, to sort those different screens and approaches. And you have the ability to track passing companies in the portfolio managers. So if you see some companies that look interesting, build up a portfolio, track them, put them in a watch list, follow them for a while. You can also subscribe and get to our member benefit of a weekly e-newsletter on stock screening and stock analysis. That comes out every Wednesday. If you want more frequent updates of information, you could also subscribe to the A+ Investor, Platinum, or Stock Investor Pro subscription. And then you get the daily passing list of companies, as well as access to the stock grades and the stock grade screener. So that gives you kind of a overview of the screening process. And I'm opening the floor to questions here, Ryan.
Yes, we actually have a lot of questions, and I also want to note that some folks are trying to get to our website, and it looks like it's a little bit down at the moment, so we apologize for any inconvenience on that. We've alerted our IT staff. But with that kind of said, we did have a lot of great questions. Let me just scroll through here. So Carl asks, can I use the screens to evaluate my portfolio's past performance, comparing, say, my past 3 years with my 2010 to 2020 performance? Is there a way to do that?
No, there is not. I mean, there is no ability. You're talking about the ability to see what stocks were held back at a different point in time.
Correct.
That's a question. There is not at this point in time that capability.
Okay. Somebody asked about the guru screens. Why are there multiple screens for individual gurus? Why isn't there just one composite screen for each guru?
Yeah, it's a good question. It depends a lot on the particular guru in place. So, and it's funny, you look at an author like O'Shaughnessy, and he's written a number of books on the screening process. And his first book that looked at it, he developed only 2 screens. He had a growth screen and a value screen. And then he had a revised edition, and he created about a half dozen different approaches. So he developed a Tiny Titans approach and things like that. He developed a half dozen approaches from that. So we took his second edition and created some new screens off of that. And then finally, he had a new book that came out, and in it, he created a composite approach. So that's what was sort of helped inspire some of the factors that we have in the value screen, for example, in our value factor. So to some degree, if a author has published different works over time, we feel as long as there's some quality towards keeping the old screens alive and they provide some useful analytics and some useful ideas, we're inclined to keep that screen up. It may be a little bit confusing at first, but hopefully by reading the descriptions, you'll understand what the source of that particular screen was and whether or not it made sense. Another one that's changed a lot over time is the Liam O'Neill approach. and his approach changed over time. And again, depending upon what edition of the book you read, the screens vary. So it gives investors and our members the opportunity to look at how the screens have changed over time and whether or not one approach may be more suited for them than another.
Along the same vein about asking about the guru screens, Monty asks, I've heard it said that once a guru method is published, it loses its effectiveness. Is that true?
You know, that's a widely debated issue or question, and it could apply towards factors as well. The key, I guess, when it comes to any kind of factor or guru is gaining some understanding as to what caused that performance to happen in the first place. You know, there are certain things that are based upon, say, human behavior, or in some case even risk. So, you know, some approaches tend to go through streaks where they're in favor and out of favor. So it may become popular for a while, and then all of a sudden it falls a little bit out of favor, and people give it up because, well, hasn't done as well as that approach for a while, and all of a sudden it comes back and it tends to do well. Value goes through streaks. Small cap companies go through streaks. So if the factors that helped lead up to that thing, if they're behavioral based, if they have some risk element, if they do better because perhaps they're a little bit riskier, or they capture some part of the market that's inefficient, they should continue to do better or do as well over time. There's always the risk that the market has changed fundamentally, and it may not be as valid going forward. But a lot of these approaches are the same approaches that I've been seeing when I first started in the industry. I mean, buying, you know, using some element of value to find attractive companies. And what we find is you don't want to typically, the approaches that do best are the ones that don't look for the cheapest of the stocks, but look for stocks that are priced reasonably well and have other good quality characteristics. That's been our experience, that good strategies typically have some element of value, but not the cheapest of element. Most companies that have, you know, very low PEs deserve to have low PEs. But they often find they have quality elements as well, or they have some competitive advantage. So they tend to hold true over time, but they might go in and out of favor for short periods of time.
Your presentation briefly mentioned Stock Investor Pro and its subscribers. There's a few questions along the nature of backtesting. Are SI Pro subscribers able to backtest the performance of their screens?
What we have with Stock Investor Pro is people can download past versions of the program. So it's not done easily, but it is possible to go ahead and download past versions of the application and run screens over time. That's how I happen to do that myself.
Frank asks, are we considering a Cathie Wood guru screen? Do you ever talk about new gurus entering into the hopper? I guess give us a little bit of color or context of how new screens enter into the mix.
Yeah, I mean, we're always looking for new ideas. I mean, we have I've been doing this for many years, and you know, I'd come across an interesting book or Wayne or Derek or Charles, and we would go ahead and analyze that approach. It would, you know, hopefully it would have some information that would be interesting to our members and would find a set of companies that should do well. In that context, we would typically write about it in the journal. We would go ahead and build up a quantitative example of how to execute it, and then we build it into our stock screen repertoire. So thank you for passing the idea about the Cathie Wood screen. It's funny, I think the second time today I've heard that name come up. So
yeah, I think she's making a lot of appearances on CNBC and is probably a person of note as of late. So
very good. I'll have to go ahead and research that.
Sure. David asks, is there a way to see how long a stock has been on a particular screen? My question relates to how one might determine when it might be too late to pick that stock, you know, in his example, when it may be about to roll off that screen.
Yeah, well, one of the things that actually is meaningful and is something that we probably should work towards improving is when it comes to the stock screening approaches itself. You know, all we're looking at are stocks that pass currently. So any stock that is on the list is passing the filter. In most cases, you probably actually want to help generate for yourself a little bit of a hold range before you sell it. Let me use the shadow stock as an example, because that has a very well-defined situation. So right now, when we're looking for new shadow stocks, we're looking for a price to book of less than one or less. But we're not going to sell it until the price to book ratio goes 3 times that initial level. So we let the price to book rise all the way up to 3. So, one of the good points to make here is that one of the advantages that we should probably work towards as far as features is to take into part and look at what would be potential sell rules for some of these approaches. So you'd have both buy screens as well as sell screens.
We have a few people asking, they're identifying themselves as, I'm an options trader, or I'm a day trader, or I'm interested in value, momentum, and they're just wondering how to identify the screens that may be appropriate for their particular situation. Can you give us a little help with that?
Well, the best thing to look at if you're going to be talking about would be the characteristics that we have on the screens. So when we talked about, if you look, for example, on the, let's see if I get control of this back. Um, these factors, in a very broad sense, help you understand what are the elements driving any particular screen. So the stock market winners screen has elements of value, elements of growth, elements of price momentum. The Graham enterprising investor screen has elements of value, elements of dividend yield, some quality, and has some industry considerations. So these will help point to some very broad element considerations of the types of factors they look at if you're value or growth focused. And secondly, if you look at the characteristics, that'll also tell you whether or not the companies that pass that particular screen tend to be more on the pricey side or growth side, as well as the grades. It'll help you indicate if a particular approach has stocks that have a lot of powerful revisions upward, a lot of momentum or not. Like in this case, if you're a momentum type trader or investor, you're probably not going to be looking at the cash rich stock approach. The stocks that make up that approach on average have a grade of D. So if you're momentum focused, you're not going to look at anything except perhaps estimated top 30, value on the move, value on the move. So actually the name makes sense, value on the move. So if you're momentum focused, you'll probably look at stocks that have better grades in that particular area.
Along similar lines, Edwin asks, how do you deal with paralysis of analysis when looking at all these screens and make a decision?
Yeah, that's always a good consideration. Too often, you start dealing with too much information. What's easiest for me and how I get around it is just find an approach or two that really makes sense for you. And I remember reading a book, and I think it was called "A Zebra and Lions Country," and we have actually, I believe we have a screen that's based upon that. And in it, the author said, investing is a bit like religion, and you have to, in effect, really come to believe in what it is you're doing and just move forward with it. Once you have developed some understanding and understand its rules, you just go ahead and follow the rules. So the key is to find a few approaches that really resonate with you, and just go ahead and start building portfolios off them. And probably if you're hesitant, and you build some hypothetical portfolios. That's one of the best things you can do is go ahead and just start paper trading or paper investing. And again, the advantage of an investor is not the trading part of it, because I encourage you not to think about trading these things frequently, because that really, you start competing against a very difficult marketplace. Your advantage is to take a longer term perspective. So again, put together a little paper portfolio, get to understand what kind of stocks pass a typical approach, and get to understand, how one goes ahead and buys them, and then whether or not you want any additional qualifying factors, whether or not you want to go ahead and take a look at some of the valuation type factors that help determine the entry and exit points.
This question I think is maybe asking for your opinion a little bit, but in response to the Piotrowski F-score screen, Jane writes, there was recently a post on Seeking Alpha on why the screen no longer works or it fell out of favor. What's your take on this situation?
I have not read the post. The Piotrowski F-score itself has a lot of interesting components to it. What's been a challenge with it is it's a very deep value approach. And what we've been finding is the Piotrowski approach was to let's take these companies that are deep value and let's find some financial qualities, these F-score things, that even though they're deep value, they have the potential to kind of either survive or do better going forward. And what we found is that we've had very few small companies passing the F-score approach. So I'll have to go ahead and read that article. But that to me, it's been more of the factor that it just there aren't. We've tried loosening it over time a little bit to try to get more companies to pass, and those still did well. So I think F-score itself has some value. I think the challenge is it's such a deep value that it's finding very few companies to pass right now.
James asks, and I'll extrapolate his question a little bit. He asks, what's the value of a screen for earnings revisions down 5%? And then I'll extrapolate further because somebody else asked, what's the value of looking at a screen where, the grades are all like D? Is there some value to looking at, screens where the performance on some measure is lower?
Yeah, I guess, that I guess is in some cases, we developed certain approaches just to see if there was a difference. And I think when we first started doing the earnings estimate revision screens, there was some research that pointed to that being a factor that was attractive, but there wasn't a lot of consensus on the value of earnings revisions. So we thought it was a very interesting tool, and we thought, well, let's see, if there's a predictive element to companies that have had downward revisions versus those that have had upward revisions. So the downward revision screen isn't so much to show that you should invest in these companies as much as it is to how did the ones that had big upward revisions do relative to those that had poor. And we found there's a big discrepancy. Now, there are some years where the downward revision screens still do well. Those are typically years where the market's turning around. And they do okay in those contexts. But as a whole, it's to help differentiate and see, is there some value to looking at stocks with positive revisions? And when you are on a separate question you asked is, well, what's the point of taking a look at, when there's a factor that has F? Well, if you're a momentum investor, if you're a William O'Neill momentum investor that's looking at companies that have consistent earnings growth, have strong quarter-over-quarter earnings growth as well, there is no value component to that particular parameter. So if you're a believer in that approach, your concern is going to be having high growth scores, and if the value is an F, it's an F. And so it's the issue is what factors are you most concerned about? And those are the ones you're going to focus in on getting good grades on. The other consideration is that it's very difficult to find companies that have, A's across the board. More than likely, if you're going to be focusing in on a company that has both value, growth, momentum, all those qualities, you're probably going to be looking for companies that are perhaps not at the extreme, but have a general consistency or ability to perform. It's a bit like, are you looking for a home run hitter that's gonna, when he hits a home run, it's gonna fly out of the ballpark, but you're gonna strike out a lot? Are you looking for a player that's gonna give you a lot of doubles? And you may not hit many home runs, but you're gonna consistently do well over time. So if you're looking for a company that has a broad selection of positive attributes, perhaps not the best attributes, you're looking for that batter that's hitting singles and doubles. Home run, okay, I'm looking only at momentum. I don't care about anything else. As long as I have some big winners, I don't care about some of the strikeouts.
Gotcha. I don't, this is maybe, these next series of questions is maybe test your knowledge of the screens overall, but this member asks, is there a screen that points to seasonality at all?
That points to seasonality. There is not. We typically, in fact, when you read about our screens, and we try to provide a lot of education. So, as an example, like when we were designing, we look at the William Can Slim screen. It has a requirement for earnings growth. And the earnings growth, in that case, quarterly earnings growth, you're comparing the current quarter against the same quarter a year ago. And it's very important when you look at quarterly earnings to look at the same period 1 year ago, because there is seasonality. And so what we try to do when we talk about these screens and we develop those kinds of factors, we try to give the education as to how you're going to go ahead and design that. When we have a factor screen that looks at price to sales, well, price to sales tends to be very industry specific. So if you just screen for low price to sales, chances are you'll be screening for companies that are in a certain industry. So when we designed our price to sales screen, we designed it looking at companies who have a price to sales ratio that's attractive to other companies in the same industry. So we try to explain that when discussing that approach. So for the most part, we don't have any screens that deal with seasonality, but we try to give you tips and understanding as to when we designed some of these filters, why they were designed a certain way, and what factors you should consider when it comes to analyzing those companies.
Another question along the same vein, this time about the Buffett-Hagstrom screen. Jane writes in and says, I'm surprised by this screen of late. It seems that some of the passing companies have very high PE ratios. How can this be if Buffett is a quote unquote value investor?
Well, that's an interesting point now. So we have three different, at least three different Buffett screens. My recollection with the Buffett screens is that they factor in on finding, first of all, companies that are what are sort of called consumer monopolies, that have some sort of competitive advantage against their peers. So the Buffettology and Buffett screens tend to focus in more on companies that have high ROEs, high profit margins, and I believe it looks at consistency of earnings and factors such as that. I'd have to do a deep dive on the Hagstrom screen to understand if there is a PE filter, but it's more than likely to be more of a PE relative filter. And by that I mean, let's take a look at the PEG ratio is a common tool, and I'm not sure if it's part of the Buffettology screen, but you're going to accept a higher PE ratio if the earnings growth is expected to be higher as well. So you could support a PE of 20 or 30 if that earnings growth is commensurate. But if the PE is, if there's no earnings growth expected, then the company has to have a low PE to be considered attractive. So in that context, some of these factors are what they call GARP approaches, growth at a reasonable approach.
We'll ask two more questions and then we'll kind of wrap up for the evening. A few people note liking your baseball analogy, saying that they often look for singles, doubles, and triples in their screens. And along those lines, I don't think we're going to add this filter necessarily, but somebody asks which screens tend to result in the most singles and doubles over time?
You know, I would look for companies or screens that have really kind of consistency year over year. And we talked about, I believe, the performance tab, which has a year-by-year breakdown, performance history. So, I mean, I would look for strategies that just kind of are perhaps they're not ever hitting the big numbers any given year, but they're not having any big losses. So I always like to look at the year-by-year to get a sense for the volatility of a different approach.
Gotcha. And lastly, this member writes in to asks, how do major events like the current pandemic and, as another example, the 2008-2009 financial crisis affect the integrity of the screen results? I mean, you're showing here the performance year over year, but how do like world events like this that kind of affect the markets impact the results of the screens?
Well, I'm not sure if the issue is not so much the results, but probably the opportunities. It was a lot of last year was a very interesting year to be doing these screens and seeing which companies passed. I mean, we went from a situation at the beginning of the year where companies were looking to be very expensive to in a very few months, if you as long as you believed the world wasn't coming to an end, looking very cheap. Um, and so it was if you had were following with our weekly. Actually, I think we started our weekly. We switched to weekly screens back then. In fact, now that I think about it, we actually started our weekly screening e-newsletter during the pandemic last year because we were seeing so many interesting companies come across these screens, and we thought it was important to sort of educate our members on how to use these approaches to find interesting candidates. And so we try to focus in on all of a sudden, you have stocks that are passing these filters because they're very good companies, and they're selling at very attractive prices. So as long as again, the key here is you have to believe that um, uh, the world will come back and the markets will come back, and that long-term stock market will reflect the overall pace of the economy, and the economy will do better. But when you have a market downturn, it's actually a great time to actually pull out the stock screens and find some interesting candidates to put into your portfolio.
Great. Thank you, John, for answering all those questions. I know we had a varying audience tonight. People new to AAII, people who are, maybe unfamiliar with the stock screens area. I think this is really a great resource for members to, look for ideas and screens that could kind of help better inform some of their portfolio decisions that they're kind of looking for.
Well, thank you. Yeah, it was a fun presentation. I enjoyed the questions and look forward to continuing to enhance this part of our membership.
Great. Thanks to everybody for watching tonight's webinar. And as always, we have recorded this presentation. So if you've missed any part of it or would like to review it, it will be posted on aaii.com/webinars and on our YouTube channel tomorrow. We do have a number of great webinars to look forward to in the coming weeks. We typically broadcast every Wednesday at 7:30 Central, 8:30 Eastern. And with that, on behalf of John and myself and the association, thank you for watching, and we wish you good health and good wealth. Good night.
Good night. Thank you.